Weekly stock market update, part 2. Lots of earnings, US elections. You'll want to watch this. And by the way, 100,000 subscribers on YouTube. Make sure you're one of them. alpeshpatel.com/links. There's a reason we've got to that many and over 1 million likes on there as well. Now, the way I'm going to talk about the stock market update is a point I want to reiterate. This is probably the greatest fund manager in history. 39% returns per annum after fees year after year from 88 to 2018. He also passed away this year. Now, he said this: I have no opinions on any stocks. The computer has its opinions and we slavishly follow them. Well, it just so happens by coincidence I have a similar approach. We look at the data. Humans get in the way. They have biases and the like, so I avoid all of that. So I'm going to use the same approach in this stock market update. Looking at the data, yeah, in red, all of these things are expensive. You're paying $31 for every dollar of expected profits of Apple, or $28 for every dollar of expected profits of Microsoft. Now, the simple people then think, oh, well, that's really simple. All I've got to do is buy the greens and sell the reds. It doesn't work like that, sadly, because valuation is not the only basis on which stock prices move. Growth, revenue growth, for instance, which is easy to understand, growth in profits is another basis on which company share prices move, not just how much you're paying for the share and its future expected profits. In fact, implied within the payment for the share is the growth. And so sometimes you're paying a lot because of the implication of growth. That's the reason why we look at more factors than just valuation. I want to say that because that underlies everything that I say. It also underlines, out of the 18 books I've had published, and if you'd like a copy of that, alpeshpatel.com/links is where you'd go to. So let's move on then with what's happening. Well, we've had those. It's been a busy week. So this is just to show you what's already happened. Wednesday, Thursday, we've had these earnings. Apple came out, Amazon, the market didn't get spooked. Microsoft, Meta didn't get spooked. And for those who are getting a bit too excited, thinking, oh, yes, it did. Well, no, the markets didn't get spooked and they got over it very quickly. Friday, after market close, monster. None of these are going to move the markets, okay? None of these are going to move the markets. Then you've got Tuesday, you've got the election obviously coming out. None of this is going to move the markets the way the election could. And the certainty of knowing who's going to be president would help. Both are going to be spending. Hey, they're addicted to it. I used to be an intern in Congress, and I can tell you the way, and studied US politics, the way it works is you have so many vested interests, you just have to spend. Don't forget to do all of this, please. alpeshpatel.com/links. Like I said, the reason we look at value growth income through my proprietary VGI score, value growth income, is because we know from Nobel Prize winners and their research, which is in my book, that valuation is more important than growth, is more important than dividend yields, but they're all connected to price movements. Okay, so anything which is a 9, 8, 7, or 10 meets my minimum criteria. Croaky comes from Goldman Sachs Wealth Management, 30% per annum if the company's in the top quartile, which I've marked in green. Oh, by the way, these are blurred because this is a snapshot from the past. This is, some people would think that's why I blurred it. But I'll talk about the companies meeting these criteria shortly. Momentum comes from the hedge fund industry, so does Sortino, and so does Alpha. We need them all to be green. Simple as that. If I gave you 10,000 companies and said to you, these are the ones which meet all the criteria, which is the basis of the research from Nobel Prize winners, Goldman Sachs Wealth Management, and the hedge fund industry, you'd say, well, yeah, you think you've covered everything, Alpesh. Oh, let me just look at the ones which are green. Right, these ones suit my risk profile. And the way you decide if they suit your risk profile, very simple. One simple way is volatility. You just say, well, actually, I'm lower risk, therefore I want things under 10% volatility. You might say I'm really high risk, in which case you'd go there. High risk does not mean higher returns. It just means more choice to select stocks from. Okay, so let's drill down into some of this. How's the past week been for the market? Roughly, this is what's happened. Mixture of green and red. I don't care how the week's been. You'll give yourself a heart attack if you're holding things for 12 months, which is our optimal holding period for a variety of reasons, but you keep looking at things every week. You'd go crazy. This is what I prefer. Past year, yeah, right. Lots of room to make ridiculously good returns. Ridiculously good returns. Not because I'm clever, but because the people who work at these companies are clever and have produced earnings, created great products, and led to their stocks going up. So my job for my clients who when they join us, they're usually people who are miserable with St. James's Place. And thank you, St. James's Place, for doing such a piss poor job sending me so many of your former clients. And then what happens is they say, well, I'm getting returns of 3% over the last 5 years or something really pathetically poor. And so we give our clients, the data, which is the Excel spreadsheet of information, which I'll show you in just a second. Okay. And out of those 10,000 stocks, and by the way, none of these meet my criteria. You can see how stringent we are because none of them are green right across the top 5. And if you don't look at all the information, all the data, then you're gambling, obviously. It's like crossing the road with your eyes closed. You might get lucky, but do you really want to be relying on luck? None of these meet my criteria. And we've got companies from NASDAQ, London Stock Exchange, New York Stock Exchange. Basically, all these can go in your SIP or ISA. Now, the reason St. James's Place is so rubbish is because you falsely think their fund managers are really clever, which they might be, and can be fine companies, and they're just awfully, awfully bright people. The problem is they've been set up to fail because they're only allowed to pick stocks from, let's say, UK or European or Vietnamese because they've been given the emerging markets portfolio or the UK portfolio. So they have their hands tied behind their backs and they're screwed. They're not allowed to pick from a list of 10,000. Because fund managers I know why they don't do that, because they've got so much capital, they divide it into those little tranches and say to each fund manager you can only pick from a small tranche. Well, they're necessarily going to fail. The other key reason they fail, really simple, they can't hold cash in years like 2022, 1 year out of 7, where, for example, Meta fell 77%, the market fell 25%, you lost, in the case of Scottish Mortgage Investment Trust, 50% of your pension. Got it? I've explained it in simple terms. So I seem clever, but I'm not. All I do is three things. One, make sure that we can take advantage of that scenario, and that comes up 4 or 5 years out of 7. Secondly, give you all the data. And thirdly, just teach you how to buy a bloody stock. Go online and boom. Okay. Well, we also do a bit more than that. We tell you how much should be in cash based on your risk profile. We use Goldman Sachs Wealth Management tools for that. How much should be in exchange traded funds. 12-month holding period, and if anything drops 25% from the entry, you get the hell out of there. Okay, really kept it simple. Now, of course, you might say, it can't be that simple, Alpesh. People write books on this. Yes, they do. I've written 18 on them. So if you want to know, it's in there, and that's why I won competitions in the Financial Times and the other places. Okay, exchange traded funds. These are they. I'll do a separate video on those. How have we done so far year to date? Year to date, since January. S&P is up 22%, NASDAQ's up 22%. Coincidentally, there are many companies which are in the NASDAQ index which are also in the S&P 500. The S&P 500 is an index of 500 of the largest American companies. The NASDAQ is an exchange and companies listed upon it. It just happens to be coincidence. Well, there's an overlap of companies, but now, that's where you start. The thing that I always want to draw to people's attention, if your pension isn't up by that March, call up St. James's Place or whichever IFA wealth manager muppet you're using and ask them why the hell not. And they're going to come up with lots of bullshit about volatility, okay, because they don't like to give you these returns. Now, look at what happens. Yes, there are prolonged periods of 0% returns. Of course there are. So be patient. That's why we look at 12 months and not 5 months. There are periods where your gains go back to 0, okay? Prices do that. There are periods when they just fall. And fourthly, there are periods when they rise. Well, it rose and then fell. Rose a bit there and then fell back to there. Okay, there are periods when they just rise. That's where the gains come from. 3 times out of 4, you're not making gains. That's why people get impatient. It's why they prematurely exit. It's why we instead look at 12-month holdings, and that's why we look to try and get, well, actually double that return because we cherry pick out of those if we can. Now, part 3 will also be on this platform. So do have a look at the links in the bio. Have a look at alpeshpatel.com/links. Get in touch. I'll assess your pension portfolio and tell you why your IFA, your wealth manager, or your fund managers are doing incredibly poorly and why your pension's hardly growing more than a bank interest account over the last 5 years. How do I know? I'm not telepathic. It's because as a hedge fund manager, I know exactly how this industry works and how you're getting screwed. Okay, thank you.